I made $380 using options this week, and to do that, I used about $79,000 in collateral. This collateral was held by my brokerage account because I sold cash secured puts, and in return, I received option premium as income. So that works out to roughly 0.4% income on the total capital used for the week. And because of that, I received a few questions like, why did I take so much risk for what seems to be like a very small amount? Does this strategy actually make sense in the long term? Those are very fair questions to ask. So instead of giving opinions, let me walk you through the actual mindset and the math using practical numbers and show you why this strategy can realistically beat the S&P 500, other indexes out there, and even most hedge fund managers when done consistently. When you look at any strategy on a weekly basis, it almost always looks underwhelming. The mistake most people make is stopping the analysis right there. Yes, $380 in 1 week does not sound exciting when you compare it to $79,000. But investing is not about 1 week. It is about repeating the same high probability process over and over again. So let's zoom out a little bit. If I repeat this exact same process 4 times in a month, that's about $1,520 per month. And now let's take one step further. There are 52 weeks in a year. So if we do it consistently, that would be about $19,760 per year. That means this strategy has the potential to generate close to $20,000 annually using the same capital base. Now, let me show you this in terms of percentages. Using $79,000 in collateral, generating about $19,760 per year works out to roughly 24% annually, and that is without compounding and without counting any upside from stock appreciation. That already beats the long-term average of the S&P 500, the Nasdaq, and vast majority of actively managed hedge funds. And we are doing this without leverage, without margin, and without chasing risky trades. And here's something important. This calculation does not even include what happens if I get assigned shares. For example, if a put gets assigned, I now own a high quality stock at a price I'm comfortable owning with. I can immediately start selling covered calls. If the stock moves up and I make extra $100 to $200, that is additional return. But to stay conservative and realistic, I don't even count that upside. I focus only on premium income because that is predictable and repeatable. Alright, now let me explain how I manage risk. I usually sell put options with strike prices that are less than 10% below the current stock price. And the reason is simple. High quality stocks usually do not fall 10% in a single week unless there is a major market event. And even if they do fall temporarily, they tend to recover much faster than lower quality stocks. That is why I only sell options on companies with strong balance sheets, strong fundamentals, and clear technical support levels. Moreover, I also avoid selling puts during earnings week, FOMC announcements, and major macroeconomic events. These events can cause unpredictable swings, and I'm not interested in gambling for higher premium. My goal is to make consistent money with less risk, and most of my option trades have a holding period of less than 5 days. I usually open trades on Monday or Tuesday after reviewing weekend news, market sentiment, and any macroeconomic developments. Sometimes I make $50 to $100 in just 1 day. Now, you may also say I can also make that $50 by buying shares, which is true. But to make $50 that way, you will need to buy at least 100 shares, hope the stock moves up 50 cents, and time the exit correctly. And if the stock does not go up, what do you do then? Do you hold it? If so, for how long? At least I had no answers for this unless I take loss and move to another trade. That uncertainty breaks consistency. I have tried this approach before. At one point, I was making $1,000 a day, but I was also losing entire weeks of profit in one single bad trade. To trade like that, you have to watch 1 minute or 5 minute charts continuously, react quickly, stay glued to the screen, and sacrifice sleep and peace of mind. It burned me out, so I decided that is not the life I wanted. Though this strategy was making money, I moved away from it, and that's the best decision I took for myself. With this options approach, even if the stock moves a little bit up or down, I'm not stressed. My strike prices are way below the current price. I collect my premium and I repeat the process. It allows me to protect my capital, beat the indexes, avoid burnout, spend time with my family, focus on long-term wealth building. And honestly, ask yourself this. Do you think wealthy people spend their days staring at charts? No, they build systems that work quietly in the background. This strategy is also especially useful right now because we have had 3 straight years of nearly 20% returns in the S&P 500 and many stocks are clearly overvalued. I'm comfortable waiting for a market cool off or stocks to come closer to their 200-day moving averages. Until then, I'm happy generating income and staying patient. Markets move in cycles and this pattern has repeated for decades. This strategy may look slow on the surface, but consistency compounds in powerful ways. You do not need to become wealthy overnight. It's good if it does, but it is smarter to have a system that works even when markets are uncertain. Let me know what you think about this approach. If you are using something similar, I'd love to hear from your experience. And if you like this content so far, don't forget to like the video and subscribe to the channel. Thanks for watching and I'll see you in the next one.